All right, so you wanted us to really dig into JPMorgan Chase's third quarter earnings for 2024. And well, we aim to please. We're going beyond the headlines, folks, straight to the source, their official earnings report. And trust me, things aren't always as they appear.
Yeah, kind of like dissecting a financial frog in biology class, except this frog controls trillions of dollars and influences the global economy.
And wears a nicer suit, probably. Okay, so the headline number boasts a $12.9 billion profit, which, sounds pretty impressive on the
Right,
surface.
until you realize it's actually a 2% dip from the same time last year, not exactly the victory lap Wall Street was probably hoping for.
Not exactly. So that begs the question, how do you increase revenue by 6% but still end up with a profit decline? That's the puzzle we're here to solve today.
Exactly. And to do that, we're going to have to roll up our sleeves and get a little messy. The report's a beast, broken down by segments like consumer banking, commercial and investment banking, asset and wealth management, each with its own story.
So where do we even begin with this thing?
Well, a good starting point with any bank, especially one as big as JP Morgan, is net interest income.
Okay, and remind me, net interest income. That's basically.
It's the difference between what they earn on loans and what they pay out in interest on deposits. Think of it as their profit margin on lending money.
Right, of course. But if their overall revenue went up, shouldn't this net interest income have climbed too?
Well, it did. But here's the catch. It only inched up by a measly 1% this quarter, excluding their more volatile markets segment.
1%. That's it. I thought higher interest rates were supposed to be a good thing for banks.
Usually are, but it's not always that straightforward.
Yeah.
See, there's this other little thing impacting their bottom line, credit costs.
Ah, right, because banks are bracing for more people to default on their loans if the economy sours.
Exactly. And JP Morgan Chase has set aside a hefty chunk of change this quarter, $3.1 billion to be precise, to cover potential loan defaults. That's a significant jump from previous quarters.
3.1 billion. Yikes. Sounds like they're battening down the hatches for a potential economic storm.
That's one way to put it. And it makes you wonder if this has something to do with their consumer banking segment taking a bit of a nosedive this quarter.
Oh yeah, 31% drop year over year is hard to ignore. What's going on there?
Well, that's a whole other can of worms. Declining deposits, escalating expenses. We'll get into the nitty-gritty of it later. But let's just say it seems like Main Street might be feeling the pinch more than Wall Street right now.
Interesting. Okay, so we've got sluggish growth in net interest income, a massive increase in credit costs, and a consumer banking segment that's, well, not thriving, to say the least. This is already getting juicy. So it's like Main Street is bracing for impact while Wall Street keeps partying like it's 2023. What exactly is going on in the consumer banking segment?
Well, for starters, people are getting smarter with their money.
Smarter. How so?
Well, they're pulling money out of those basic savings accounts because even with the higher interest rates, those accounts aren't yielding much. They're looking for better returns elsewhere.
Makes sense. Why let your money sit idle when inflation is eating away at your savings?
Precisely. But that creates a bit of a problem for banks like JP Morgan.
Oh, how so?
Well, they benefit from those higher interest rates on loans, but they also need to offer competitive rates to attract and keep deposits. It's a delicate balancing act.
A delicate balancing act made even trickier when you've got expenses climbing higher. That's like, I don't know, trying to juggle chainsaws while riding a unicycle.
A vivid image, but I get your point. And the report specifically mentions rising costs for staff and marketing. Even a financial giant like JP Morgan isn't immune to inflation or the fight for top talent, apparently.
And let's not forget about those credit card charge-offs we talked about earlier.
Right. That's a key indicator of how consumers are actually behaving. And this uptick in charge-offs suggests that more and more people are finding it tough to keep up with their credit card payments, which, reflects a broader trend of economic anxiety.
Yeah.
People feel uncertain, they tighten their belts, or worse, they fall behind on their bills.
And considering how dominant JP Morgan Chase is in the credit card market, this could be a sign of things to come for the entire economy, right?
It's certainly something to watch closely. Gives you a glimpse into consumer confidence, spending habits, all of that. But it's not all doom and gloom. Remember that contrast we talked about earlier between Main Street and Wall Street?
Oh, you mean how JP Morgan Chase's commercial and investment bank segment is doing just fine while regular folks are struggling?
Exactly. While consumer banking faltered, commercial and investment banking boasted a 13% surge in net income. Their equity markets segment, in particular, had a stellar quarter.
So the big players are still making money while everyone else is tightening their belts.
Seems that way. Despite the economic jitters, there's still a good deal of optimism, or at least activity, in the stock market. Whether that's sustainable in the long term is another question altogether.
The million-dollar question. And I guess to even begin to answer that, we need to look at what Jamie Dimon, the CEO of JPMorgan Chase, had to say about the current economic climate. He's not exactly known for mincing words.
True that. And he didn't hold back this time either. He called the current geopolitical situation, and I quote, treacherous and getting worse.
Okay, that sounds more like a line from a spy thriller than an earnings report.
Right. What else did he say? Let me see. Yes, he expressed concerns about inflation, rising fiscal deficits, the usual suspects, and global instability in general.
Okay, so not exactly sunshine and rainbows, but is he being genuine, or is this just a savvy CEO trying to manage investor expectations? Like, is he really worried, or is he trying to soften the blow in case the economy really tanks?
That's always the question, isn't it? Hard to tell if it's genuine concern or strategic communication when it comes to these CEO pronouncements.
True, true. But you gotta admit, Diamond's got his finger on the pulse, so to speak. When he talks, people listen. Anything else stand out from his comments?
Well, he did emphasize the importance of a strong financial system, but also one that doesn't stifle economic growth. Kind of a nuanced stance, advocating for regulation, but not at the cost of progress,
Easier said than done, I imagine. It's a tightrope walk, finding that balance.
Exactly. And this is where it gets interesting because institutions like JPMorgan Chase, they have a lot of say in how those regulations are shaped. They're not just following the rules, they're helping to write them.
Talk about influence. But wouldn't that suggest that they have a vested interest in making sure those regulations don't end up hurting their own bottom line?
Right, exactly. It's this delicate dance between power and responsibility.
Sounds like we're trying to solve a financial riddle wrapped in an enigma.
That's a good way to put it. But that's why we're here, right? To unravel these things, try to understand what's really going on.
Absolutely. So for our listeners who are still with us, what's the TLDR on JP Morgan Chase? What's the takeaway here?
Well, it's a bit of a mixed bag. They're facing headwinds with those rising credit costs and the shaky consumer banking segment. But they've also got a strong commercial and investment banking performance to fall back on, not to mention a healthy amount of cash reserves.
So are they cautiously optimistic or optimistically cautious?
Maybe a bit of both. But what I find most interesting is Diamond's call for that strong financial system, but one that doesn't stifle economic growth. It's a noble goal, but it also makes you wonder how much influence should institutions like JPMorgan Chase have in shaping those regulations?
Yeah, that's the million-dollar question, isn't it? And probably a question for another deep dive. For all the talk about numbers and balance sheets, it's Jamie Dimon's comments that really stick with me. Calling the geopolitical situation treacherous, that's not exactly reassuring.
Yeah, it's not like he's prone to exaggeration. And,
Yeah.
the guy's got access to information and analysis that most of us can only dream of.
So he's not just whistling Dixie here. He really sees trouble on the horizon.
Well, I mean, we can't get inside his head, but his track record speaks for itself. Remember back in, 2022, when that whole thing went down with,
The specific geopolitical event.
yeah, exactly. JPMorgan Chase, they quietly shifted a bunch of their investments, hedged against the uncertainty, turned out to be a brilliant move, protected their assets while everyone else was scrambling.
So he's playing chess while the rest of us are playing checkers. That makes his whole treacherous comment even more unsettling.
Right. Like, what does he know that we don't?
And is he already positioning JP Morgan Chase to capitalize on it, maybe even at the expense of those who aren't paying attention?
That's the billion-dollar question, isn't it? And it kind of highlights the crazy amount of power these financial institutions really have. Like, it's one thing to react to economic shifts. It's another thing entirely to, even unintentionally, benefit from them.
I'm starting to see why we do this whole deep dive thing. We're not just crunching numbers here. We're trying to understand how these guys think, what makes them tick.
That's what makes it fun.
Right, totally. Okay, so back to Diamond's comments. He also talked about the need for a strong financial system, but also warned against stifling growth. It's a tough balance to strike.
Absolutely. Regulation is important, but you don't want to choke the economy with it either. It's a tightrope walk for sure.
And let's not forget, institutions like JP Morgan Chase, they have a pretty big say in how those regulations are shaped.
Oh, for sure. Their lobbying power is nothing to sneeze at.
So it makes you wonder, are they always going to act in the best interest of the little guy? Or are they going to prioritize their bottom line every time?
It's like the old saying, right?
Yeah,
About the fox guarding the hen house.
exactly. We all want a stable financial system, but we also got to be wary of those who might benefit a little too much from how it's structured.
Couldn't have said it better myself.
So as we wrap things up here, what's the one thing you want our listeners to take away from all of this? What's the big lesson from our JPMorgan Chase deep dive?
Don't just scratch the surface, you know.
Mm-hmm.
Don't take those headlines at face value. Don't just blindly trust what any CEO, even Jamie Dimon, might be saying. Dig a little deeper. Ask the hard questions. Figure out what motivates these guys, what the consequences of their actions might be. Because in the financial world, knowledge is power.
Couldn't agree more. Well, folks, there you have it. Another deep dive in the books.
Until next time.
Stay curious out there.